How to retire as a couple. 5 planning mistakes to avoid. Planning for retirement is complicated, but when you're planning for 2 people, 2 sets of priorities, 2 timelines, and sometimes 2 very different ideas of what retirement even looks like, it gets a lot more complex. And here's what I've seen after working with so many couples over the years. Even if you saved well, even if you've done the right thing, it's really easy to miss key details that can cost you in taxes, income, and long-term security. So in this video, I want to walk you through 5 common retirement mistakes couples make, and more importantly, how to avoid them. Hi, I'm Joshua Bliss, founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. If you're planning for retirement as a couple, this is for you. And if you find it helpful, don't forget to like the video, leave a comment, and subscribe for more clear retirement planning insights. Let's walk through it. Mistake number 1, assuming you should retire at the same time. A lot of couples come into my office with this picture in their mind. They both walk out of work on the same day, hand in hand, and never look back. It's a beautiful idea, and emotionally, it makes perfect sense. But financially, that decision can create unnecessary pressure, especially if it's not backed by the numbers. Let's break this down. Different retirement ages, different realities. It's common for couples to have an age gap of 2 to 5 years, sometimes more. And if the younger spouse retires early to keep pace, they may end up waiting longer for Medicare, delaying or reducing their Social Security benefit, and increasing the number of years they'll need to fund retirement from savings alone. Meanwhile, the older spouse might be in their peak earning years, when retirement contributions are highest and Social Security credits are still growing. If both spouses retire at the same time, you could be walking away from tens or even hundreds of thousands of dollars in combined income and future benefits. What we recommend instead, rather than defaulting to the same retirement date, consider these questions. What happens if one spouse works 2 to 3 years longer? Can that extra income help delay Social Security or cover health care costs for the younger spouse? Does it create an opportunity to save more or convert taxable assets to Roth during lower income years? Staggering your retirement by just a few years can reduce your withdrawal rate early on, strengthen the surviving spouse's income security, and give your investments more time to grow while you cover expenses with earned income. I recently worked with a couple. He's 66 and she's 61. They both plan to retire at 65, but once we ran the projections, we saw that if he retired now and she just worked 3 more years, they could delay both Social Security benefits, save an additional $90,000 in catch-up contributions, and avoid pulling from the portfolio until her Medicare kicked in. They got more income, paid less in taxes, and gained peace of mind, all by not rushing to retire at the same time. So yes, retiring together sounds ideal, but retiring smart together, that's what really sets couples up for long-term success. Mistake number 2, treating Social Security like an individual decision. Social Security might feel like a personal decision. When should I claim my benefit? But if you're married, it's not just about your benefit. It's about how both of your benefits work together over time. And what happens to those benefits when one of you passes away? This is one of the most overlooked areas I see in couple-based retirement planning, and it can take a 6-figure difference over the course of retirement. Why coordination matters. Each spouse has their own claiming options, but your decisions are interconnected. Here's what many people miss. When one spouse dies, their surviving spouse keeps the larger of the 2 benefits, not both. That means the higher earner's benefits becomes the default income for the rest of the surviving spouse's life. So delaying that higher benefit up to age 70 can provide a much stronger foundation for long-term income security. If both spouses claim early, say at 62, you may be locking in smaller checks that don't just reduce income today, they reduce income for the rest of your retirement and for the survivor as well. The strategic approach. Here's what we typically evaluate when we work with couples. Who's the higher earner? That benefit is often the one we aim to delay. How healthy are both spouses? Longevity risk plays a role in the decision. Do you have other income sources that could bridge the gap while waiting? Sometimes one spouse claims early while the other delays. Sometimes both delay to strengthen future income. But the key is we don't make those decisions in isolation. It's about building an income plan for 2 lifetimes, not just one. I had a couple in recent. She earned more over her career, and he was about to file at 62 just because he could. But once we walked through the numbers, they saw that if she delayed until age 70, her benefit would grow by about $1,000 per month. That larger amount would become his benefit if she passed first. And then they could bridge the early years with withdrawals from a taxable account at a lower tax rate. That's smart coordination, and it gave them peace of mind that no matter what happened, the surviving spouse would be taken care of. So the takeaway here is simple. Social Security isn't just a me decision, it's a we decision. And the couples who take the time to plan together are often the ones who get the most from it. Mistake number 3, ignoring the healthcare gap. One of the biggest blind spots I see when couples plan for retirement is this. They assume healthcare will just work itself out. But when one spouse retires early, especially before age 65, and the other is still working or already covered by Medicare, things can get complicated fast. This gap between retirement and Medicare eligibility can cost thousands per year and catch couples off guard. Here's a common scenario. Spouse A retires at 62. Spouse B is still working, or maybe they've already retired and are on Medicare. Now spouse A needs to find coverage for 3 years before Medicare begins at 65. What options do you have? COBRA, often expensive, and it's usually limited to 18 to 36 months. The ACA marketplace plans, based off income, but premiums can be steep if you don't plan withdrawals carefully. Private individual coverage, often the highest cost option, especially with fewer subsidies. We're talking $800 to $1,500 per month in premiums for early retirees, not including deductibles or out-of-pocket expenses. Multiply that over several years and it can take a serious bite out of your retirement income plan. How we plan around it? When we're building retirement income strategies for couples, one of the first questions I ask is, what's your health insurance plan between retirement and Medicare? From there, we look at whether it makes sense for one spouse to keep working longer just for the healthcare coverage, whether we can use taxable accounts or Roth withdrawals to keep ACA income thresholds low and qualifying for subsidies, and how those premium costs fit into your broader monthly income plan. We don't leave it by chance, we bake it into the plan. I worked with a couple where the wife wanted to retire at 63, but her husband wouldn't hit Medicare until 65. Rather than paying $1,200 a month in premiums for private coverage, they adjusted their income in a way that qualified them for ACA subsidies, cutting their out-of-pocket costs by more than half. It's a great example of why cash flow and tax planning go hand in hand with healthcare decisions. So the key here is simple. If one of you plans to retire before Medicare kicks in, you need a specific strategy to cover that gap. It's just not a cost issue. It's about keeping your retirement plan stable and predictable even in those in-between years. Mistake number 4, not coordinating withdrawals across accounts. You spent years building up retirement savings across different accounts, 401ks, IRAs, Roths, brokerage accounts, maybe even annuities. But here's the problem I see all the time with couples. They treat all those assets like one big pool and they start pulling money out without a coordinated plan. The result? They end up paying more in taxes than they need to. They trigger Medicare surcharges earlier than expected, and they run through their most flexible assets too quickly. Let's break it down. Every account type comes with different tax rules. Traditional IRAs or 401ks, fully taxable when withdrawn. Roth IRAs, tax-free, and they don't trigger RMDs. Brokerage accounts, only the gains are taxable and potentially at 0% if your income is low. HSAs or annuities often have their own unique tax considerations. When you retire as a couple, you're not just choosing where to take money from, you're choosing how your tax bill is calculated every single year. Why this matters for couples. When both spouses are retired, or even if one still works, how you structure your withdrawal affects how much of your Social Security is taxed, whether you cross into a higher federal tax bracket, if your Medicare premiums jump due to IRMAA, and whether you lose deductions or credits tied to income thresholds. This isn't just a tax issue, it's a cash flow issue. Because once you pay unnecessary taxes or surcharges, that money is gone. And in retirement, you want to be as efficient as possible. How we approach it. With couples, we often use what's called a multi-bucket withdrawal strategy. That means starting with taxable accounts to keep income low early on. Using Roths strategically for tax-free flexibility. Tapping into IRAs gradually to avoid big required minimum distributions later on. And sometimes doing partial Roth conversions in lower income years. We model it out not just for this year, but for 10, 15, even 25 years because the sequence matters. I worked with a couple who were drawing almost everything from their IRA in early retirement because that's where most of the money was. But once we looked at the bigger picture, we shifted some of the withdrawals to a brokerage account with lower capital gains and saved them more than $4,000 per year in taxes and Medicare surcharges. Same total income, just smarter distribution. So here's the key takeaway. If you're retiring as a couple, you need more than a good investment strategy. You need a withdrawal strategy that reflects reflects your income needs, your tax situation, and your long-term goals as a team. Mistake number 5, failing to plan for the surviving spouse. This is the conversation no one likes to have, but it's one of the most important, because eventually retirement will shift from a we plan to a me plan. When that happens, the surviving spouse may face a very different financial reality. Let's walk through why that matters and how to prepare. The financial picture changes sometimes drastically. Here's what typically happens when one spouse passes away. You lose one Social Security benefit, and often it's a smaller one. You go from married filing jointly to single on your tax return. Your tax brackets shrink, but your income may not. And healthcare decisions, long-term care concerns, and required distributions all shift onto one person. This means the surviving spouse can pay more in taxes on less income, something we call the widow's penalty. And unless you plan for it, it can feel like a double hit. Emotional loss followed by financial uncertainty. How we plan around it. With every couple I work with, we run what's called a survivor scenario. We ask, what happens if one of you passes at 75 or 85? Will the surviving spouse have enough income to maintain their lifestyle? Are accounts properly titled and accessible? Are we minimizing future RMDs and taxes, especially if only one spouse remains? Sometimes we delay the higher earning Social Security so that the survivor gets a larger benefit. Other times, we do partial Roth conversions early to reduce taxable income down the road, knowing the survivor will face a higher effective tax rate later. And in some cases, we adjust how assets are held so that the surviving spouse can access income without triggering a tax surprise. I worked with a couple a few years back where the husband had a military pension and the wife had no earned income. We planned the retirement together, but also looked at what would happen if he passed first. By adjusting his pension to include spousal continuation, delaying his Social Security, and doing some early tax planning, we were able to ensure that her income and tax burden stayed manageable, even if she outlived him by 15 years. And that gave them both peace of mind. So here's the bottom line. If you're planning for retirement as a couple, you also need to plan for the day when one of you may continue the journey alone. That's not pessimism. That's what real financial planning looks like. Retirement planning as a couple isn't just about setting a date and checking a few boxes. It's about coordinating 2 lives, 2 timelines, and 2 sets of goals into one plan that actually works in real life. Let's quickly recap the 5 key mistakes to avoid. Number 1, retiring at the same time without running the numbers. Number 2, treating Social Security like an individual decision. Number 3, ignoring the healthcare gap between retirement and Medicare. Number 4, not coordinating withdrawals across different account types. Number 5, failing to plan for the survivor spouse's income, taxes, and access to assets. Each of these can impact your retirement more than most couples realize. But the good news is they're all avoidable with the right planning. If you and your spouse want a retirement plan that's built for real life, not just a spreadsheet, let's talk. Click the link in the description below, book a free consultation. We'll walk through your income, your timeline, your benefits, and your priorities together. And I'll help you create a coordinated strategy that supports both of you for the long haul. Thanks for watching, and I'll see you in the next video.